Thank you for joining iMeet. When you hear the tone, you will be the 22nd person to join the meeting. The meeting is now being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. And what we're going to do today is just review last week's action, see what's going on for this week. Then we'll look at some of the different indexes and sectors. And at the end of this, we'll have about 20-25 minutes of me talking. Then we'll open it up to questions. If you have anything you'd like to talk about as far as individual stocks or industries, targets, anything else on your mind, we'll see if we have time to go over it. Later on today, what we're going to try to do is look at some of these sectors that have gone up 30-35%, some of these industry groups since the election, and see if there's some places that or some segments of those sectors that we may want to take some profits in, especially with some negative divergence showing up in some of the different industries and sectors now. So first thing what we're going to do is we're going to look at the Dow. We actually made another new high last week. Looks strong, but we are, for the first time in a little while again, starting to see some more negative divergence. Nothing much. We had this big gap up on Wednesday after Trump's speech to Congress, and now we're kind of working back and forth. Usually when you have a gap like this, it doesn't take long before this gap gets filled. So be cautious of that, but I think we'll probably, that was around 20,800 or so. I imagine we'll probably get down and fill this because the other indexes have mostly filled that gap already. Okay, the pivot point right now is right around 2498. That's where if we get down to there, you should find some support. If it breaks below that, we may get a little bit more selling going on. But anyway, the momentum index last week with this little bit of a pullback was -1. It was neutral. I put the numbers in the market letter after yesterday's pullback, and the momentum index actually fell to a -4 because you still have the Dow Jones outperforming all the other indexes, and that's a little bit of a red flag. You may have heard the saying, when the generals walk alone, you want to pull back, and that's kind of what's going on now. The Dow Jones, a week or two ago, right, this area was making a brand new high, like 12 days in a row. Outperforming all the other industries. But the chart looks good. What you're going to see here probably fill this gap. Well, it's a little bit of consolidation is healthy for the broader market. There's still a couple red flags in here that I want to go over. If you read the Friday weekly market letter, we talk about from Investors Intelligence, the percentage of bullish investment advisors hit 63.1% last week. That's the highest level since 1987. So we do have still a little bit too much exuberance out there. There's another indicator that I watch occasionally that above 85 is a sell signal. That's called the DSI indicator. It's the daily small trader market sentiment forecast. It's on futures. You can get that on currencies and everything. It's a very expensive subscription. But that came in last week at 92, and above 85 is a sell signal. Over the last couple of years, maybe 20 years or so, it's gotten above that 91, 92 level 3 times. And on all 3 instances, the market corrected anywhere from 7 to 11%. So again, just the amount of bullishness out there is still worrisome. A lot of good things going on as far as what Trump's pro-growth, pro-business policies are. But just the fact that we're very overbought and means you want to have some caution going in here. Here's another chart. Here's the advanced decline line for the NYSE. Even though we're making the new highs, you're starting to see a little bit of this rolling over. It's a little bit more of a correction on that than we've had recently. Today, we're probably going to lose another 1,000 points, so we'll see that coming down here. That's looking a little bit toppy. It's something you want to watch for. Another thing we look at is on the NYSE and the NASDAQ is the number of new 52-week highs versus new lows. You can see over here yesterday was the first time that we've had more new lows and new highs since going back over here into November, right before the election. We also have more new lows today than we have new highs. So back to back, that hasn't happened since the last week of October. So again, we're seeing a little bit of cracks in the armor. nothing crazy, and some good consolidation over here is healthy for the broader market. But it's just something that, you know, I want you to take a look at. As far as this, another thing I want to look at on the chart, going back to here, we have the pivot point, I said it was around 20,500. Just below that, we have the first support from the pivot points, which is around 20,189. That also coincides with where the 50-day moving average is. And when you get several indicators that kind of point to the same level, you want to take a little bit more notice of that because that convergence of those indicators usually adds to the support level. So if we come back here and break this 25 area, you know, maybe we go back here to around the 22 area, but at this point, you know, things are still looking to this, the MACD and all, and the little bit of a pullback from the overbought condition. At this stage, is just telling us there's going to be some consolidation, nothing to get too excited about yet. Okay, here's the S&P 500. This chart looks much like the Dow as far as what's going on. You did get an actual sell signal on the short-term MACD, which is the 1226.9. The 14-day RSI with today's little bit of a pullback is working off some of its overbought condition. And the 30-day stochastic, which I look at for more of a trend following thing, is kind of rolled over also, but certainly nothing's given a sell signal in here. This just means some consolidation. As you can see over here, we're really close to filling in this little bit of a gap from last Wednesday. So you want to watch that. We get down here to about 2330, 2335 is the pivot point. This is where you're going to find some major support in here. I would consider if we get down here and break through that, you can get a test down here, the 2305 area for the 50-day moving average. That's kind of taking away this whole last bit of the rally from the beginning of February. So that's certainly an area you want to watch, this 2335. If that is broken, I'm pretty sure we'll get a test of this 50-day. Then we'll kind of see what happens from there. But at this stage, I'm not seeing the kind of divergence that calls for a big sell-off in anything. Okay, here's the NASDAQ. With the NASDAQ, let's see, we're still working off some of its overbought condition. It's actually, you know, with the technology sector in there, quite strong, and also the biotechs recently are actually in the process of breaking out above that 300 level. You got a little bit of pullback in here, a little sell in the MACD of the short term. This one you have filled the gap on the NASDAQ, which is good for the market. Again, the little bit of divergence we're seeing in here is basically just some backing and filling, which is still good. Until we get down to somewhere, let's see, right around the 38.2% Fibonacci is down here around, I can't read my numbers in here, but the 50-day is right around here, around 56.65. That's where we would, if we get a little bit more serious selling, we would get that. But at this stage, I'm not looking for any more of a pullback than about 57.60. That would be the pivot point for the NASDAQ. We look over here at the AD line. Again, you're having a little bit of negative convergence on that, or negative divergence. We're down about 1,000 units again today, which would take us down to about here. When you watch this thing at the market at a glance on the Market Edge homepage, you can get this. If you see this AD line break below this, that's going to be more than just a little bit of a red flag, because that's going to break the advanced decline line accumulation numbers going back all the way into December. So I'm not sure that's going to happen at this stage, but just something to keep an eye on. If you go into that, look at that daily, that gets down to this point. If it hits down here and bounces back up, it could be a sign that a near-term bottom is in. And also, we had a little bit of the negative convergence on the 52-week new high and new low on the NASDAQ. We're still getting more new highs, but even today, but it's very close. That's contracting. That's a sign that as the market's holding up in here, less and less stocks are participating in that. Now, one thing I also wanted to bring about on the S&P 500 that I forgot to mention, I also keep track about of how many stocks are actually within, besides making new highs, how many stocks are within 1% of making a new high or making a new low. As of yesterday, we were at right around about 20.5% of stocks in the S&P 500 were within 1% of a new high. That's the lowest since the first day of February. We actually got up in the 30s during that time period of this last rally. Also yesterday, 10.32% of the stocks in the S&P 500 were within 1% of making a new low, and that's the highest level since before the election. So we are getting like that. That's showing more and more stocks are coming off the highs and starting to roll over, versus fewer and fewer stocks beginning to make new 52-week highs. Remember a year ago, this past December, we went to a sell on the market. We were pointing that we only had something like we had 25 or 30% of the stocks in the S&P 500 were within 1% of making a new low, versus about 10-12% making new highs. So that was a big red flag at that. But it's not too serious right now, but it is something that you want to at least be aware of. Okay, here's the Russell 2000. As we speak, we're still at this 1379. And this thing's been hugging this thing for three straight days. That's the 50-day moving average. Despite the thing holding on to that support level, that's also where the pivot number is. It's 1380, 1379. You're seeing the negative divergence in here. You really can't ignore. Here we are. We're making a little bit of high over here. We start working our way higher gradually. Negative divergence coming down here. Here's the 14-day relative strength showing momentum has actually gone negative at this stage for the Russell 2000. 30-day stochastics are also coming down here. When they cross over 50, it would be a little bit of a sell signal in there. But you're not seeing a crack in any of these things, which is a little bit surprising. But over the weekend, one thing I want to point out, one of the reasons why we're seeing so the market's hanging in here after such a big run up, a lot of the institutional traders are actually kind of sitting on the sidelines. They're almost fully invested, but they're not selling anything at this stage. But what we're seeing is all the talk about investors going to passive index funds is actually you're seeing a big input of money into ETF index funds from what we call mom and pops, and that's supplying the money. You're seeing they're buying the same stocks, they're in the same indexes, and that's kind of keeping a bottom on this market right at this stage. The problem with everybody buying an index fund, it holds it up at this level, but once the thing starts to roll over and selling starts, it's going to push the market too far in either direction. Too much money going into them, it's going to be at the top. When the market starts to roll over and everybody decides, hey, this market's going to zero, that's when everybody's going to escalate their selling. It's going to cause the market to go too far in the other direction. So that's one of the things why I don't like about just investing in passive ETF and index funds. Certainly an amount of your money could go in there, but I still think individual stocks should hold a place in your portfolios. Like we talked a couple times, we had coal last year. It was up 100%. That's probably not something you would have been invested in. But if you have a couple of those, it's going to help you outperform the market. So anyway, keep watching this Russell 2000. If we break below 1375, which would be right about here, that could induce some follow-through selling with some of the other indexes. So be careful about that, because that pivot point and the 50-day moving average are all right here, this 1375 to 1378 area, and that means that's a strong support. But again, if that breaks, it's going to be a red flag, and it may induce some more selling down here, at least to this 1321 area. I would expect that to probably be support back here, which you have polarity in the market, which is former support zones become the next support zone. So that's where I think it would come down here, which would be around the 21-day moving average. And again, the negative divergence in some of these indicators tells me that I think we're probably going to break through on that. So the other one over here is the transports, which have had a nice, they've been holding up pretty steady. A couple made a new high over here about a week ago. But again, you don't quite have the positive momentum in the transports that you would expect as you're breaking out to new highs. Negative divergence over here with another sell on the MACD. 14-day RSI actually was negative this morning. We're down about 58 points to about the 93.60 area. If the transports get down here to about break below 93.40, which is right around the pivot point, and then you have the 50-day to 92.80, that's going to be a little bit of a problem. The big deal down here is still around 9,000, which we talked about over here. It came right down to that point and held back here in the first of the year. Came down, looked at it, tested it again, and bounced off of that. So if we get another test down to that area, 9,000 would certainly be an area that we would probably want to consider that the broader market maybe due for a bit more of a pullback. All right, before we go looking on that, I wanted to talk a little bit about the sectors. What looks strong in here, what's neutral, what looks like it's deteriorating, and then we're going to talk about when we see the negative divergence showing up in a sector that we own some stocks in. How can we decide if we want to hold on to what we own or whether we want to hold on or buy more on a pullback or whatever. So what we're going to look at here is, first off, this is the technology sector. Okay, one of the problems that I had or questions that I had this weekend was someone came up and was talking about sectors and industry groups with me, and they wanted to know how we can have we talk about relative strength. We want to be in the areas of the market that are outperforming the S&P 500. So you want your relative strength to be above 1. How can we have an industry or a sector that maybe comes in at, say, 0.95 or 0.92, yet we rate it as strong? And actually what that just means is, the relative strength that we use is a 50-day relative strength. And when it's above 1, that means that sector industry has been outperforming the market over the last 50 days. Now, if we have something that is a relative strength of 0.94 or 0.95, that just means that that may be an area over here where the thing pulled back, and right over here we're starting to we're getting strong again. And it's not outperforming the S&P 500, but it is strong, and the other indicators, the score and the power rating, are such that that the thing is going to be upgraded and should have more upside to it to go at that stage. So that's how you can have something. And in fact, when you see a sector industry below 1 that actually shows up as strong in our industry group or ETF center, it's probably an area that you want to see what is strong in that group, and maybe you'll start to look at some ETFs or stocks in that area that are generally going to try to catch up with the market. Anyway, so here's the technology. It's still the strongest sector in the whole market. Semiconductors are still, I think, one of the top 2 industries in the market. You don't have much of a pullback. If you take a look at from this to this is the 50-day, or we'll use the 100-day in this case. Remember, a lot of times we talk about using putting your thumb on this line and your first finger up to this line, and you kind of measure how far away you are from this moving average to the top. Then you can go back and measure that historically to see how overbought you are. And it's amazing that little trick will get you in here where you'll see something like this and say, wow, that's about as far as it ever gets away. What happens? You end up going sideways, maybe correct a little bit, and then eventually you'll start to take off again. And when it gets to be too far, you'll see the thing correct again. It's just a really simple little trick that you can use just with eyeball something to make sure that it's not too far. Now, on the S&P 500, I believe on Thursday and Friday, that index was almost 9% above the 200-day moving average. The last time that had happened was sometime in 2014, and the market corrected that discrepancy and pulled back a little bit. Again, we're pulling back a little bit here the last day or two. Again, if you see that with that little finger trick, you'll know that this thing is due for some sideways action. But as far as the indicators go on the technology sector, nothing wrong. So I'm not looking for any subgroups or industries to sell in that. Okay, here's the financial sector. It took off. This was one of the strongest sectors up to this point. Had some consolidation when investors wanted to make sure Trump's policies were going to actually come to fruition. We kind of got a little bit of that here. We started talking about rate hikes going up. That's good for bank stocks. We have had a little bit of a pullback. Haven't filled this gap yet from last week, but you are having a little bit of negative divergence. I think part of that was during this time period. They weren't. Yellen was talking about she wasn't really looking to raise rates yet. Once we got in the positive rate talk, we started to pick up again. That's going to be good for your financials, for your banks, for your insurance groups, for your diversified financial groups, even on your online brokerage firms, especially. Your TD Ameritrades, your Schwabs, your E-Trades. These, especially these, they don't have a lot of overhead. And when you get the funds coming in and rates go up, they can make an awful lot of money just from a half-point pickup in interest rates. So despite a little bit of a pullback because of the pricing wars, I would use the pullback on any of those online brokerage firms as a buying opportunity. Again, a little bit of a negative divergence you're seeing here. I expect to see this probably work its way out. Maybe the market pulls back and we come back down to the pivot point. But over the longer run, I wouldn't be looking to be selling stocks in the financial sector. You may get a pullback to here, but I don't think you can time these things fast enough where you buy a Bank of America, you sell it at 24.5, and you try to buy it back at 23 or something like that. That's the new bottom. I'll leave that to the algorithms or something like that. Here we have this is something I wanted to include today. Because last week I talked about where you might, or the last couple of weeks, where it's something I look at to see when I think a trend has changed, that's going to stay bullish for a while. This is the XLF. This is the 21 exponential moving average and the 34 exponential moving average. And when I see those cross over on a weekly chart, as long as that 21 week is above the 34 week, I'm going to be long that stock or that sector. Okay, in this case, you're seeing the actual expansion going on in the weekly model here. Again, that's just telling me that the strength of this thing we may get a little consolidation, but you want to be in the financial sector. We're going to look at some of the other sectors using that same moving averages. Okay, here's the consumer discretionary select spider. You made a new high on this one also last week, but you're having a little bit of slowing momentum down here. Nothing crazy as far as the divergence goes. You've got a little bit of an uptrend here that you can come into if this thing falls below this pivot point area. That would be a little bit of a red flag. But there's a lot of different subgroups in the consumer discretionary that cause this negative divergence in here. And that's what we're going to talk about at the very end of this after we go over that. Okay, here's the 21 to 34 day exponential moving average. If you use this thing, if you were to come out right around the election, you'd come back into it about 2 or 3 days afterwards. It looks strong. On the weekly chart, the RSI is confirming the move higher. You're getting some expansion in between those two moving averages, and that looks good on that. So again, not a sector that I just want to sell outright or I see breaking down. But there was some negative divergence that we'll look at on some of the industries later. Okay, here's the materials sector. Materials, not quite as strong as some of the other things over here. Lots of negative divergence. You see, we're kind of in a trading zone over here, possible double top. Now, this had a nice run up over here, but over the last year, going back from last year, actually going back to last February, you're up about 45% on this sector. But we're right here testing the pivot point right now. Today, XLB is down another 0.5%, 52 and change. Okay, we're in the process right now of breaking this pivot point, which is a little bit of a red flag. So we're most likely going to come down here to test this first support level, which also is the 50-day moving average on this sector. You're getting a little bit of a pullback down in volume, but here's the negative divergence showing up in the MACD. You made a new high over here in the sector in the ETF, but you didn't make a new high on the 14-day RSI, negative divergence, and you also couldn't make a new high on the 30-day stochastic, and you're coming back down towards the 50 level. A break below that would probably signal that you're going to come down at least to the 50-day and maybe a little bit lower. As you can see, when this 30-day stochastic breaks above the 50 level, normally you get a pretty good size move in that thing. This thing here, it broke, but you kind of went sideways on the downside. But this is one that I want to watch, and we'll take a look at some different industry groups in the materials sector that may be a place where we could take some money off the table. Okay, over here is the 21-day and 34-day moving average exponential of this. It looks strong, looks fine. And you'll notice over here you don't see the negative divergence on this chart when you look at the weekly charts. So a lot of times on these sectors, the divergence on the weekly chart is much more. You want to pay more attention to that than the daily, because the weekly is going to wash out some of these wild swings. Yeah, this looks like it's just marching straight up. But if you go back to this, well, you're having some problems in this thing. You look like you're wondering what the heck to do with this thing. Again, the weekly will take out the noise, and you just stepping up higher on this thing. A little bit toppy on some of these wicks, candlestick wicks, but in general, you're not getting much of a divergence in the different indicators. But we'll look at some industry groups in that, looking for sales. Okay, another one group I like. We talked a little bit a couple weeks ago about the healthcare sector. A big run up here from the end of January. You're getting a little bit of a pullover over here. I don't consider this negative divergence. I would just look at this as you may get a little bit of a pullback. You had a gap down this morning. That was due mainly to Trump tweeting something out again. So I wouldn't worry about that. Something about he wanted to talk about there's going to be some more competition for drug pricing, which could affect the pharmaceuticals. But that's you got to wait a couple of days, I think, on that thing. It could possibly be a double top on here. I don't think it's going to be. I think you'll consolidate a little bit in here, and then you'll probably work your way higher. One of the reasons is because you're getting you've just gotten this new buy signal here using the 21 and 34-day EMAs. So you can see that you're picking up strength. The 14-day RSI and the weekly is picking up strength. You've had a couple of nice rolls in here. This is your buy signal that you looked for. They're starting to spread. So I think this is going to be one of the areas that you want to be adding to positions. Here's a chart that you have to kind of like if you've been buying biotechs. You kind of have a little bit of a reverse head and shoulders over here. You have this $300 level, which you've hit several times. We broke above that, gap down below. I think we're moving back up on that today as we speak. Now you're down again on today, so you're kind of wrestling around in this area. But as long as this thing goes back above 300, that's a breakout that traders have been looking for a long time. This thing's been as high as 400 and change going back over a year or two. So you maybe get a little bit of consolidation with these indicators. In fact, this would be fine again. It's not overbought in here with this little gap down. So I would look to add to the Nasdaq the biotechs. If you measure from here to here, and you use your fingers for that, that's going to give you a target of the upside when it breaks through here, probably somewhere right around 335 to 340 on this ETF. So that's something you want to. I would be looking to buy biotechs. And that was the materials sector. I had too many charts. And here's the utilities sector. Again, we talked about this about being a buy a couple weeks ago, which was kind of surprising when we were over here. We thought that this thing looked like it was going to start to break out, and it did. But now you've kind of got, to me, it's looking a little bit toppy in here. I wasn't sure why we broke out, but something you don't have to know why all the time. You just follow the charts and do what they tell you to do. You're getting a little bit of consolidation in here. If you look at the weekly, over here was where we were talking about that. Surprisingly, you were getting another buy signal on the utilities. With the weekly chart, you don't have that negative divergence. Maybe get a little bit of consolidation. Keep an eye on this for double top. If we would come back down here and roll over, that could be a little bit of trouble. However, you still have to remember that these things are paying somewhere around 5, 6, 7%, 5 to 6%, and our 2-year or 10-year Treasury yield still somewhere around 2.5. So I don't think you're going to see a big pullback in here. But if you go and look at the industry groups, again, when you look at groups that may be looking a little toppy, you'll see some industries in that sector are starting to break down. They're starting to underperform. So that may be an area in the utilities. There may be 1 or 2 industries in this group that are starting to break down a little bit. Okay, lastly here is, or next to the last, this is the consumer staples. Again, you're seeing a little bit of a rollover, some consolidation over here over the last couple of weeks. The indicators are kind of pulling down. You had a new high in the 14-day RSI, confirming this breakout over here. This again to me is nothing more than some consolidation after a big run up. If you look at the 21, 34-day EMA on the weekly chart, you just had another buy in this thing about 3 or 4 weeks ago, and you're breaking this out to new highs. So any consolidation in this would represent a buying opportunity in that. Okay, the last one we're going to look at is the real estate sector. XLRE is this one. You had a nice, you had a pullback over here. When people started talking about the rising rates from last summer, this along with some of the pharmaceuticals and some of the other things started to break down. We broke to the upside, came down, tested this downward trend line here. We broke back up, went above the 50-day and the 200-day over here. Here's the 50-day getting ready to break up. This actually looks like something where if you came down in here, maybe see if it's going to test this 200-day, you might get a chance to add to that. Mainly it's because the yields on that are still pretty good. I think real estate, the business conditions are good, could be a good buy for you. And here's the XLRE on the weekly chart, and you got a new buy signal over here in the last week or so from that. So if this pulls back, you may look to buy some of these REITs at this stage, because I think they are looking to go for a buy. I wanted to put the energy in here. I see now that I forgot to do it, but the energy XLE looks to me like it is putting in at the bottom. We can look at that later on when we start to ask the questions. But it came down like this, went up a little bit, pulled back down. We bounced along here. And the XLE looks to me like we possibly may be starting to pick up a little bit. There may be an area that we may want to look at some oil-related stocks going forward. But we'll look at that at the very end. Okay. So we look at a couple of the groups. All of these are still on a buy as far as the different sectors. There's nothing on here. You have some, the negative divergence that is showing up on the daily charts isn't being confirmed by the weekly charts. So all we're seeing on here at this stage is consolidation, which tells you that there's subgroups in the sectors may be weakening. And if you're looking to take some money off the table to go into some of the stronger sectors or some of the sectors that have underperformed it, but now they look like they're going to outperform, what you can do, and what I will do sometimes is I'll go to industry group analysis, and you can list them by condition. If you click on condition, it's going to list these by strongest to the weakest. And once you get down here to where they're deteriorating, if the relative strength is like here we have aluminum at 1.14, that was just the strongest industry just a week or two ago. I'm not looking to sell stocks in that quite yet. But when I do see things like industrial technology, media publishing, here's lodging, the telephone systems. Let's see, some of the banks, but I like the sector in the banks, so I'm not really going to look to sell that. But if you look at some of these things and you see that the sector is starting to show negative divergence, you can come in here and you'll click on some of these industry groups, and it's going to give you a list of the stocks from strongest to weakest. Now here's a group, when we looked at lodging. Okay, here's the S&P 500. It's going like this. Look at this. Look at how the lodging industry has outperformed the S&P 500. Okay, you can look at this thing going back a whole year. It's up about 40%. But you'll get a list of stocks in here. Most of these are still strong. Vail Resorts, Intercontinental Hotels. But down here at the bottom, you'll get a couple that you may want to look at that probably aren't participating. And these may be stocks that are going to lag you that you may want to get out of. Here's Marcus, La Quinta, and Hyatt. Okay, I pulled up La Quinta over here. You can see it came down here. Actually, this may be sort of a bottoming pattern, but you have a double bottom in here, and you took off of this, and now you've rolled over. I'm not sure what happened here 2 days ago, but this may be a stock that if you own it, you probably want to see it give a little test down here to the 1271. It breaks below that, these moving averages. It's probably one you want to let go of. Again, you're looking at a stock that's in a good sector, but the industry itself is showing negative divergence, and it's underperforming the S&P 500. This may be an area where you want to look at some different stocks to sell. Okay, another one that came up on there that was underperforming is airlines. Airlines have had a heck of a run over in here. They've been kind of going sideways since. And if you look over here, we actually only have one or two airlines that are still rated a buy in the Market Edge second opinion. The rest of them have been downgraded basically to avoid. So that includes your Delta, your American Airlines, Spirit, JetBlue. You pull up a chart over here on Delta. You can see where the thing was going sideways. It actually started to roll over here. Okay, now we've got a little bit of a topping thing. It keeps getting up to this 52.5 area, bumping into that a couple times, 1, 2, 3, 4, 5, 6, 7 times. Can't get through that 52 area. We're now down here this morning. We're testing the 50-day moving average. You're also getting some negative. You've got a little bit of a sell here on the MACD. If I've been in the this is on a weekly chart also, and I could have looked at the daily. But this is a weekly. If we look at this thing here, you may want to consider that the negative divergence on this is in the weekly. Remember we talked about if you're getting the weekly divergence on the weekly chart, that you want to pay attention to. And as Delta was over here trying to make a new high, it was an unconfirmed new high by the 14-day RSI as well as the MACD. This is one now here that if it breaks through this 50-day, and I've made my money in here over the last, say, 15, 20 weeks or so on some of the airlines. This may be an area that I could lighten up on. Where I want to go back in would be if we get a solid break above the 52.50 area. But most of these airline charts are looking a little bit toppy over here. And again, we remember we looked at the Dow Jones Transportation Index is one that we're getting very, very close to breaking down. If that breaks through some of those the support areas that we talked about, okay, that's again confirmation that we probably want to take our profits in some of these airline stocks. Another one is that, again, on the weekly chart, that showed up, had a real nice run off of the Trump, rally for the infrastructure stocks. Heavy machinery. Oh, this is JetBlue. I'm sorry. Okay, here's another. JetBlue is trying to fight its 250-day. Again, we have the little bit of negative convergence. Momentum is weak. You're almost going to cross this 50 level on the 30-day stochastic, and the MACD already has a sell. So if we get much more weakness in the transports, JetBlue may be another one that you probably want to sell, and you maybe get a trade from this 1950 area down here to this 1890, maybe or 1690, 17 area, maybe a little bit lower. And we can look at the point and figure charts on some of those to see where this thing probably bottoms out. But again, you're getting a couple confirmation signals here from the broader chart, from the index, and also from the industry group. Okay, here's another one, heavy machinery. You can see how here's the S&P 500. You can see how this thing has took off with the infrastructure spending right in here, and now it's kind of going sideways. Part of this is they want to see some timelines for when we go into this. A lot of stocks like Deere, let's see, ABC, Abco. Some of these are still rated strong and buys, but then some of these are actually starting to pull back, like Caterpillar, and some of the others have actually kind of bottomed or starting to move up again. But we have a couple in here. Here's one, ASTE, Aztec Industries. It's an avoid. Come over here. It's a subgroup of the materials that are struggling. Okay, here's Aztec on a weekly chart. You've broken down below the 50. Now we're trying to hold this. This is the 21-day 34. I'm sorry. So you're trying to hold on to this level. You also have an upward rising trend line. We're struggling to hold that or break below that. You could get some selling in here. And here also, we're making new highs. And again, this is the weekly chart. Okay, that you're not getting. This is the negative divergence that we look for on the weekly. That is more important than on the daily charts on this thing. You also have the negative divergence on the MACD. So this is one that if I'm looking to pull some money out of something, if I had a nice trade on this thing, going back here from right here up, I may want to consider taking some profits off on that thing. So if you're looking after this rally and you think that maybe we're overdue for a little bit of a pullback, I've showed you a couple screens that I think are important that you can find some ideas. Again, you look for the major index that you're in, whether it's the transports, the utility, or the Russell 2000. If you're looking at small caps, you can look at the daily on the index. See if you see any negative divergence. See what's going to break down as far as the moving averages go, and then you go look at you look at the weekly, get confirmation of that, and if you get confirmation on the weekly, like something like in this thing, then you can go to the subgroups on the industry groups, and you find something that's either deteriorating or weak, and look for something that's already broken below 1.0 on the 50-day relative strength, and that'll give you some ideas of where you want to stocks you actually want to sell. Now, I'm not expecting like a 10, 7 or 8, 9, 10, 11% pullback in the market. I'd love to see it at 4 or 5%, maybe come down, test the 50-day moving average on some of these bigger indexes, and then see how we hold up there and go forward. But I think, as I said a couple of times in the weekly letters, I think your risk, not for lack of growth or potential growth in the market, I think it's more political. This weekend we had, North Korea fire a couple test missiles. You always have the worry of Trump coming out with a tweet or something saying, ticking somebody off that can rattle things up a little bit. But he is in a stage where the regular businesses are knowing what regulations are going to be. They don't have to worry about surprises coming. They've got a lot of money in the kitty, and they are going to spend that money for new development. That's going to propel this bull market going forward for quite a while. So, if you have some questions, please come in. I've gone a little bit longer than I want to. Got a couple on here real quickly that I'll try to get to. No sound. Great. Okay. Linda, EWU. This is a FTSE. Okay, I'm going to go ahead and try to see if I can get some charts up here real quickly. Okay, I wanted to close this out. Bear with me just for a second. We'll get the screens up here. EWU and BK. Okay. EWU. Okay, this is England. Of all the European countries, I'm not real strong on EWU. As far as a second opinion goes, we have a try to get on this thing. Sorry about that. Okay, we still have a long with a stop down in here around 31.25. The thing today is at 31.65. You've had a pretty good pullback in here. You're probably going to get a test down here of this 50-day moving average. A little bit of negative divergence going on in this. I think there's some problems with over in Europe. They don't have the growth that we're getting. In fact, this morning, Germany, their factory orders for January or for the last month hit an 8-year low, which is a little bit it's troubling. And the other thing with Europe, if I'm not already in there, these votes with France, and you have the Netherlands, I think you have Greece, Italy. You have an awful lot of elections coming up that could, whether it's just a real quick pop like what you had back here with Brexit, where you went from 32 all the way down here to 27 when we bounced back. But that worries me. I just think that there's too many risks in Europe at this stage. Let them get through here a couple more months to look at, to see what happens with some of these elections before I would go in there. If you wanted to be diversified and go in there, I would probably stick with Germany, EWG, Austria, EWO. There's some other ETFs that I like as far as developed countries. I like DFJ, which is I think that's a dividend fund for Japan, which has been pretty good. Another one is FEZ, which I think is a dividend total Europe fund. I think you'd be probably better off in this case. Like I say, if you don't own Germany or Austria, you're probably better off with that FEZ and own a broader based thing. Another one we had a question on was BK. Here's the Bank of New York. It looks fine. It's the daily chart. We're up here banging on new highs. Again, any of these things where you have this, you haven't filled this gap yet, so you may get a chance to buy this thing. If the market would roll over a little bit, you would probably have a chance to buy this down around the 50-day. If I'm not in the financials right at this moment, I'm looking to go into the financials on any kind of a pullback where we get a test of the 50-day moving average, something like that. Again, with the rates rising, that's somewhere where you eventually want to have exposure to that. And by exposure, you could have whether it was this or an online firm, or an insurance like a Travelers or a Prudential, something like that. Those are areas that you want to have money going into it. Got a bunch more here. Let's see. USD. That's the U.S. dollar Alta before earnings. I'm kind of like Jim Cramer. I'm not big on the retail stocks like this. You have a stock, extra stock, a single pinch stop has reached even if rated long money flow. That was okay. Let me get to these real quick. USD. This is the this is Alta semiconductor. I guess a double thing. I like it. If you're going to be in a leveraged ETF, again, remember this. We looked at the technology sector. It's still the strongest place in the market, and this is going to be a little bit more volatile in the broader market because it's leveraged. But today you're up today is one of the few pockets today that's up in the market. I think this goes on to make new highs. You just stair-stepping up higher until you see, even with that NVIDIA pulling back 20-some% in the last couple of weeks, this thing's still making new highs. So I believe that if you own this thing, I'd still be in it. Okay, look at Facebook. Okay. Facebook, a long wick on this. If you're a real big technician, you actually made a new all-time high on that. A little bit of negative divergence, and a little bit of you see a little bit of a pullback. As you're making a new high, it's not confirmed by the volume. Some of this, I would. Well, I'm just saying this. I don't know, but I would think some of this would be due to some people maybe coming out of this and putting some money to work in Snap with all the hype that was leading up to it. But you're still kind of moving higher into this thing. You got resistance up here now. This 138 and change. This isn't really negative divergence to me. This is some consolidation of what's going on. I like Facebook. I think that would be one you buy on another pullback or anything. Okay, somebody want to know. While I look at another SPR. Okay, Spirit Aero Systems. This is one. Okay, we looked at the with the negative divergence on some of this, the 14-day RSI. A little bit, and some negative divergence on this. Let me change one thing here real quick. Okay, you do have some negative divergence on the RSI in here. Not much. This is more consolidation in here. If you're looking to you're breaking out to new highs. I like stocks that are breaking out to new highs. I don't think I would put a sell on this thing by any means. I would let this thing ride for a while. You're getting 50 days, get ready to cross above the 100-day. This is one of the airlines that may be a little bit. Actually, if I'm not mistaken, this isn't an airline itself. I thought this was a company that did parts for airlines or something like that. I'd have to recheck that because I own this in one of the portfolios. But in this case, just looking at the chart, I wouldn't be looking to sell this thing. It looks strong, even despite it's outperforming the Dow Jones Transportation and the broader market. Now, somebody had a question just a second ago, and I'm trying to hurry up. If we're long a stock and it breaks the sell stop and everything else is positive, it's going to whether I would sell it when it breaks the sell stop is going to depend on a few things. What my time horizon is. If I've owned the thing for a long time, I see the sector starting to break down. Also, if I see that the industry itself starting to show negative divergence, starting to break down, that would cause me a concern. I wouldn't sell it on a break intraday. I might wait for one or 2 days, possibly even 3 days before it breaks the sell stop to sell it, or even possibly let it go 3% below the sell stop, and then I would think that would be more of a red flag and confirm that maybe something's breaking on this thing. Okay, I've gone way over the line. We're almost gone a whole hour today. I'm sorry about that. I appreciate all the questions, and if you have some other questions during the week, please email me at the doc at marketedge.com or support. I hope you got something out of this today. We'll be back next week. It's actually my birthday next Tuesday, so we'll have a little party on this thing. But thank you again. I hope you enjoyed this Tech Talk, and talk to you during the week.